So I think I'll just proceed with my presentation today. It's about Malaysian Market Outlook 2019. All right. 2020. Yeah, gotcha. So, few highlights. There are a few themes that I would like to highlight for Malaysia. Somehow our economy is still prone to the external uncertainties of the global outlook. For example, the trade war between US and China. And then there's a slowing global economy and US protectionism policy. So when I talk about US protectionism policy, it's not about US and China. If you notice in the news, what happened is US also successfully got their interests done with NAFTA, Mexico and Canada. And now they're aiming with Europe on the tariff and also China. So this is one of the uncertainties that are going to continue for the next year. And then at the same time, we have a weakening data. Latest number by Korea was a bit bad. So, Korea is one of the main hub also for US global, for the global trade. So when when the trade data from Korea is bad, so it reflects the whole Asia. And then for Malaysia, second theme for next year is domestic political uncertainties. Of course, we have an issue of leadership. Now a lot of talks with the current government, whether who's going to become the prime minister, whether it's Anwar or it's Mahathir, and also infighting within the pact. So this is one of the political risks that we have in Malaysia. Third would be the cautious growth outlook for 2020, because we are still, because of these uncertainties in the market, a lot of lack of catalysts for foreign funds to invest in Malaysia. And fourth would be in terms of the monetary policy. Bank Negara Malaysia will likely to continue in terms of the dovish policy outlook, in terms of giving more, stepping into the market to protect, to help elevate the global or the Malaysian global slowdown. So the view at the moment, market has priced in for one cut within first quarter 2020. So for right now, the OPR is at 3%. So if there's one cut, it's at 2.75%. And lastly is I'll talk about the expansionary budget for 2020. All right, these are these few highlights for our Malaysian market next year. So before we go into the outlook for 2020, I would like to highlight in terms of what has happened in 2019. So the latest GDP figure for Malaysian market, third quarter release in October, a few weeks ago, showed that our economic growth contracted at 4.4% against 4.9% in previous quarter. So you can see the graph here. This graph I took from Metastock Zenith, which is a partner with Refinitiv. At the same time, in terms of the contributor for the GDP of Malaysia, largely it's because of our services and manufacturing sectors. That's the key backbone of our economy. And at the same time, in terms of our private final consumptions, expenditure, largely contributed by the GDP growth for third quarter was contributed by the private final consumption, followed by the government expenditure, and then lastly will be exports. Nonetheless, our fixed capital is actually quite down because of the business uncertainties, and so a lot of corporates they prefer to have wait and see kind of direction. And lastly, if you talk about current account, of course, Malaysia is still a current account surplus at 11.5 billion. But this figure actually a slight drop compared to the quarter before, which is at 14.3 billion. So from there, we know that our current account actually narrowing a bit. So things are not that gloomy in 2019. Not that rosy, but not that gloomy as well, because it's somewhat a bit balanced. But yeah, this is something that we'd like to highlight. At the same time, globally, because Malaysia is one of the, we are an open economy. So if you see the graph on the left, this I took from Bloomberg, in terms of global PMI performance since December 2017, you've seen throughout the end of 2018 and going into 2019, global PMI actually has dropped. So the green color shows that the PMI is actually quite bullish, quite good, and the red color is actually quite gloomy, quite bad. So if you can see, Germany is one of the, in terms of global PMI, in terms of their PMI numbers, it's actually has dropped quite significantly. And if you see from this graph, Eurozone, they're actually facing recession risks. And for global PMI, anything sub 50 is considered as technical recession, even though it's not an economic recession, but it's just a technical recession. But somehow, in terms of manufacturing, even the global manufacturing PMI has slowed down. It's still supported by services. Services still above 50 index. So if we know globally, in terms of for example, if you want to look at sectors, services are still there. The room for growth is still there. It's just on the manufacturing side, it's a bit down. Nonetheless, you can see there's a king here. So we expect that with the central bank's help and also global monetary easing direction, this could spell a bottom. So maybe PMI started to pick up again for the next year. Okay. So about Malaysia, just now we talked about global PMI, right? So how about Malaysia? Malaysian manufacturing PMI recorded an improvement in the last reporting date. Nonetheless, it is still sub 50. So technically, it's still a technical recession of PMI, but there's an improvement. And then in terms of business confidence, it remains subdued because of the uncertainties in the global market. And if you notice, this figure here is at, I can see there it's about 90 something. So, yeah, 94. So it remains subdued. Nonetheless, our trade balance in October, as I mentioned earlier, recorded a surplus. And from here, we expect things might have bottomed up in September. But in terms of consumer confidence index, it has improved in second quarter from a low of 86 points. So in terms of consumer side, there's an improvement. All right. So what does Bank Negara do? In 2019, there's one cut which happened in May. So from 3.25% in OPR, it cut to 25 basis points to 3%. And people was expecting for another cut for this year. It didn't happen because Bank Negara said we'll look at data and we'll look at external developments. Nonetheless, with this cut, you notice that the CPI index in October actually recorded all-time high since 1972. So the CPI index is colored this green color. So CPI is an all-time high. So in terms of inflationary pressure, is still there. And year-on-year growth is about 1%. So that's our inflation. And the main contributor for the CPI is actually alcoholic beverages and tobacco. That's the biggest contributor on the CPI numbers. Second will be food and beverages, non-alcoholic beverages. So you know, everybody in Malaysia, they feel the pinch of foods are getting more expensive. Restaurants, which is another subsector of food, restaurants is there. And also healthcare, as well as the utilities, gas especially. And for 2020, might be a possibility there's no more subsidy for the B40s. I mean, there will be only targeted subsidies for Malaysians. And the talks is maybe there will be a 1 cent hike every single week. So because of that, the CPI numbers will go up higher and higher. And this will be affected by the increase in fuel prices, which is utilities, restaurants, food, and transport. Everything's going to go up higher. So the view for next year, of course, our inflationary pressure is there. Nonetheless, somehow, one thing about Malaysian, even though things are getting more expensive, we still buy new iPhones, we still buy new cars, we still buy new, for example, Mazda CX-8 releasing soon. So people still buying a new one. We can see, in terms of index, consumer spending, it shows increasing trend of 7.14% in third quarter 2019. So this is something that, you know, even though people are complaining about inflation is high, everything is high, cost of living is high, but still people willing to spend their money. All right. Okay, outlook for 2020. So this is from the budget actually. One thing I'd like to highlight, the recent budget 2020, the government has a very bullish, I would say, more like positive and also optimistic view on the economy, because our minister mentioned that in terms of 2020 GDP growth, our government projected at 4.8%, while at the same time, IMF projecting about 4.4%. So that's a huge number. And at the same time, the market will be the analysts, economists in the market, also projecting about 4.4%. So our government is slightly on the bullish side. So because of that, their reason is largely it's because of the private expenditure will be contributing a lot next year. Of course, in terms of whether it is going to be contributed for the GDP growth, it's something that we can question and we can debate about. And at the same time, in terms of public expenditure is actually the government spending. So it will contribute about 2.5% from the GDP growth. So yeah, so basically this is just a summary on what is the government looking at, what is the market looking at, and what is the IMF looking at. So from there, that's why even though there's no cut by Bank Negara Malaysia after the May cut this year, right? I'm projecting there will be another cut next year. In fact, right now the market is looking at one cut in the first quarter 2020. But because of these figures, nonetheless, Malaysia being Malaysia, we still have pressures from government or from certain parties. If the numbers doesn't kick in and doesn't goes up to 4.8%, there'll be more pressure for Bank Negara to further cut the interest rates. So maybe right now people are pressing for one cut, maybe there's possibility for another two cuts, maybe on the first half and the second half of 2020. Okay? So just to quote the source, it's actually from MOF, IMF, UOB and Maybank. So I compile all the averages here. So some of the key silent points from the budget 2020, MOF mentioned that the GDP growth driven by domestic demand and resilient private sector spending. So technically, it's because of the 11 Malaysian plan, to the end of Malaysian plan. And we have to watch out at the end of the year, 2020, there will be 12 Malaysian plan. So this is something that we need to watch out, what kind of sectors will be benefiting from the 12 Malaysian plan. Nonetheless, in terms of fiscal deficit is targeted to narrow to 51.7 billion ringgit or 3.2% GDP in 2020. So although it is higher than initially 3% in 2019 budget, nonetheless is a show of improvement in our fiscal deficit. So in terms of Malaysian rating by the credit agencies throughout the world, at least we can still maintain our rating at the current rate. Okay, and at the same time, in terms of the bond market, because bond market basically give a gauge on what kind of products offering in the market that makes people from outside interested to invest in Malaysia for the yield, because they want to invest in the country for the yield anyway. So issuances for 2020 will remain steady in MGS and GRI. MGS is Malaysian Government Security. GRI is the Islamic version, which is government investment issue. They expect to be about 117 billion, as well as PDS is private debt security, basically the bonds issued by companies. Okay, so about 56 billion. Because of we have an expectation that there will be a lot of ongoing mega infrastructure projects such as Bandar Malaysia, JB, Singapore Rail Transit, and also MRT3, MRT2, LRT3. So companies like George Ken is one of the beneficiary of these projects, and also Gamuda. All right. So as a summary for budget 2020, we have a narrower fiscal deficit from negative 3.4 improved to negative 3.2%. And then we have a positive growth. The government is expecting from 4.7% this year to become 4.8% next year. At the same time, the assumption used is our commodity price is between 63 to 62 remains stable. In terms of infrastructure spending, so this is something that you need to watch out. Infrastructure spending is about 56 billion next year. And then you have a cash aid for targeted subsidies, although in terms of the middle income it's not affected much. So maybe in terms of private consumption, for me, when the government says it's quite bullish, for me it's a bit subdued the numbers. And then a lot of worker incentives, people coming back to work after paternity or maternity leaves. At the same time, implementation of IR 4.0 and also 5G in Penang especially. So this may be a catalyst for the technology sectors. And then benefits on the SME exporters, where government giving a lot of benefits on there. Property, and also next year is, we remember, Visit Malaysia year 2020, tourism. So this is on services, right? So this is the key breakdown from the budget 2020. If you notice here, the government has allocated roughly about 4.8% more than 2019 on developmental expenditure. So when I say about these kind of things, you know, there's a catalyst by the government to pump money into the market in these particular sectors. So in terms of your sector allocation, whether which sector to invest in or to look at, you have to watch out on these kind of things. So developmental expenditure, construction especially. And then at the same time, private expenditure, the government expecting it to be around 5.8% change higher than the previous year. Okay. All right. Next, in terms of the KLCI performance for year to date actually, for 2019. So for 2019, this is FVM KLCI performance. So what happened is, this is as of yesterday, the KLCI closed at 1568, and year to date has dropped to negative 7.22%. So whoever invested in the KLCI index from the earlier of the year, you've lost 7%. But I know a lot of members of that system, they're actually making a lot of money in technology stocks because of a lot of technology companies. Dufu, Jeff-Tech, all went up very, very high actually. Yeah. And then in terms of PE, right now, KLCI is at 17.14. So what I did before coming into the presentation, I did a relative valuation for KLCI. Since 2015, why to 2015? This was the peak of KLCI last time, right? So what I did is I look at the average PE for KLCI index. So the average is about 16.5. Okay? And I look at the standard deviations of the valuation of KLCI. And if you notice, the KLCI now moving towards the mean, which is 16.5, from a high of almost 18. So there's if you're a quant guy or technical analyst, you know the strategy of mean reversion. You're far away from the mean, it will go back to the mean. So we expect the PE for KLCI will start to drop again towards the mean and will start to kick up again. Alright? So this is for IBM KLCI. Alright? So a lot of people, not just quants, not just technical analysts, but also fundamental guys, when they want to invest in our country, they will look at the valuation. Okay? So this is FVM KLCI. Next will be the mid 70 index. So if you invest in mid 70 index early of the year, you made 5.92% until today. And the PE is a bit higher than the FVM KLCI. It's at 18.14. And if you look at the relative valuation for mid cap, the mean is roughly about 15 and the high is roughly about 19. Okay? And if you see, even in 2017, before the big drop, the mean, the PE mean is about, the PE figures is about 19, and it dropped to the low of actually 10.5. And now, in terms of valuation, it is still at high. Will it still stay here higher, or actually going to drop? In terms of risk and reward, I think it will gonna go back towards the mean. Okay. Next will be our small caps. Small caps is one of the darlings for this year. Year to date, yes, you have made, if you invest in day one in January, is 20.86% returns year to date. And the PE, relatively, as of today, is still low, 9.74. If you see this graph, the mean for the small cap is at 10.53 in terms of valuation. And it went as high as 12.2 here. And now it has dropped lower than the mean. So why? One reason is because a lot of the small caps, even though the price has increased, their earnings increase a lot more better. So that's why their PE ratio has dropped. Because in terms of price and earnings, price divided by the earnings. If the earnings is good and getting bigger and bigger, your PE ratio getting lower and lower, right? So now, in terms of companies or sectors to look at, we can focus on the small caps. Because why? The PE is near to the mean, and there's a drop here. So it gives more opportunity compared to if you're investing in the mid caps or even in the large cap like FVM KLCI. Alright. So far, any questions? You can stop me here for now. Any questions on the valuations? All okay? Clear? Alright, so this is just in terms of relative strength of the KLCI constituents. So this is the list of all 30 stocks. And you will see from here, the top performer for KLCI is actually PPB, SMW, IOI, MISC, SINW, KLK. And you notice from here, how many of these companies are actually in plantation sectors. SINW is plantation, IOI, corporation is plantation, and then PPB is also in plantation. So a lot of plantation stocks actually tops the rank in terms of performance this year. And if you look at this table, this is 40 weeks low and 40 weeks high. And for SINW, it's actually on the high side at the moment. And in terms of technical, if you look at simple moving averages, all of these stocks is in the bullish state. All right. And in terms of RSI, relative strength index, also all of them, from PBB, Dialog, IMB, all of them actually in the bullish zone, above 50. Okay. And the laggards of FVM KLCI, Public Bank, IHH Group, Petronas, Maxis. If you notice, DG, it's all telco companies. And also mining, like Petronas, where the RSI is actually still below 50. So if you join or if you learn about technical analysis, you know how to read RSI. Anything above 50 is bullish, anything below 50 is bearish. So these stocks in FVM KLCI are still in bearish zone. And if you look at the performance, are still in the red. So for me, if I'm the fund manager, of course I would, in terms of valuation, I will look at these companies for valuation. But in terms of momentum, for me to make quick money, easy and fast way, I will look at stocks with good momentum, bullish momentum, because we can only long, we cannot short the market. Okay. So this pie chart shows the market cap by each sector. Just now we mentioned plantations and services are actually on the high side, while telco actually low side of the performance. True enough, in terms of market segments, you have the consumers and non-cyclicals, and then you have the financials, the biggest pie in the market segments. But the telco is a smaller pie. So and technically, if something going to happen, KLCI in the telco sectors, for example, DG is down, it doesn't impact much on the KLCI performance index. Okay, and one thing to note, in terms of sectors in Malaysia, biggest sector of KLCI components are actually in utilities. So this might impacted by the government policy next year. So you have to watch out on the utility companies. So if there's a cut in terms of subsidy, then there might be an impact on their valuation and also earnings. All right. Okay. Just now I mentioned about what makes the market in, for example, what makes overseas investors interested to invest in our market. Basically, you look at valuation. So where is FVM KLCI now compared to our peers? Right now, we are actually at the low side. Actually, more than -1 standard deviation. So in terms of our peers in Asia, KLCI is considered cheap. Although just now we look at relative performance of KLCI throughout the last 5 years, it looks a bit near to on the high side, but going down to the average. But if you look at our peers, we are still cheap compared to other countries. And in terms of ASEAN, we are on the average and still going down. So things are cheap in Malaysia. That's why recently there are a lot of articles in Bloomberg saying that Malaysia is a boring market, it's too cheap, but nobody interested to buy. It's all because of this. So if, because I mentioned earlier, there's a lot of uncertainties, political uncertainties, leadership. If these few factors are being resolved soon for next year, our KSI will jump as, like skyrocketed easily. Next, this is I quoted from Alliance DBS. They did a study in terms of KLCI earnings growth driver, and they expect that banking in terms of growth driver are there because of the expectation of rate cut and the recent SRR cut by Bank Negara Malaysia give more capital for the banks to invest their money, hence more profit. So that's why they put it as one of the key factor for growth. In terms of plantation is also one of the growth factor, because if you look at CPO has went up to above 2,800 level per ton this week, and in fact on Friday yesterday it closed at, if I'm not mistaken, 2,840, around that level. Although there's a sell-off at the end of the day, but yeah, it went up quite a lot. So plantation is one of the key driver for next year. The rest, the laggards, is gaming. So gaming like Genting is still not much key growth for next year. Okay, and lastly, we're healthcare. So nonetheless, this is a bit of valuation. So we talk about fundamental. How about the technical side? Oh, it's on dark color. Alright. Okay, this is KSCI technical view on monthly basis. So monthly is more like a long term. If you can see the KLCI index, right now it has crossed below the cloud. So it's in the actually bearish zone. At the same time, I have these lines. Actually, they are red color line and also green color line. It shows the immediate support and resistance for the KLCI index. It has broken so far. So on the long term side, it is still bearish. On the medium term view, which is on weekly chart, the price still going down below the cloud is in bearish zone, and also broke the immediate support, this line, and it closed just there. All right, but nonetheless, if you notice, this low is near to last year's low. I'm not. This is 2015 low. 13, 14, yeah, 2015 low. So it's just near there. So there's an immediate support. And on daily, still bearish. So you see, long term, medium term, short term, KLCI is still bearish. This is just lack of catalyst. Nonetheless, for on daily, it is supported at this level. And I have this indicator that I construct myself. It shows an arrow up, meaning there's slightly a bullish momentum coming in, and it created a double bottom. So on technical view, on short-term basis, it has some support, but nonetheless still bearish. Medium term still bearish, long term still bearish for our KLCI index. How about the sectors? Whoops. Okay. The first one actually is plantation. I didn't put the labeling, but this chart is plantation. This one is construction, finance, technology companies, property sectors, and consumer sectors. And if you can see, monthly is such a long-term view. Plantation sectors are remain supported. It is still above 200 moving averages. So technically, it is still bullish side. But short-term on this is the blue line is 50. The yellow line is 100 moving average. So on the long-term 200, it is still bullish zone. But then you can notice there's a crossover here. Plantation might be, I would say, retraced back before continuing its momentum. So plantation technically is still in a bullish state. Nonetheless, for construction, on the long term, is still bearish. For the finance, it is still bullish, but there's crossover there. So it's similar behavior with plantation. And then on technology, it is bullish. So whoever in technology sectors, I think for this year also you guys are making money. And then for property, it is still bearish. And for consumer, for long term, it is bullish. So you see, bullish bullish, but short term there will be retracement, bullish, but short term will be retracement. So this is our monthly view. Let's look at weekly, which is the medium term view. Same, plantation, and then you have construction, finance, technology, property, and consumer. For plantation, it has crossed the moving averages, the short-term moving average, but the long-term moving average is still pointing downward. So following to our view on the longer term, just now in monthly chart, we expect plantation sector might retrace before continuing its bullish movement. And for the construction sector, right now it remains supported, but nonetheless it's still in the bearish zone. And then for finance, actually it's in bearish. And for technology, still bullish. For property, it's bearish. And consumer, still bullish. So consumer quite strong. Okay, let's look at short-term daily chart. Plantation actually shot up quite high, and it's still strongly, I would say, bullish momentum. For construction, it is slightly on the bearish side. And then for finance, it is also in the bearish side. And for short term, nonetheless, technology is still there, bullish. Property is still bearish. And then consumer, it is somewhat bearish. Okay? So as a summary, okay, before I come to the summary, this is just telco sector and transportation sector. Telco sector is still going down. That's why if you look at KLCI index, the laggards are all telco companies like DG, Axiata. That's why to show the index, it is actually pointing down. So for next year, just don't touch these companies. I mean, just don't go for these sectors. It's not worth it. And then in terms of this chart on the right is actually transportation. Also is bearish. So imagine if the government start to kick in these subsidies, right? They cut away the subsidies. What will happen to the transportation? Things are getting expensive, right? So in terms of profit, maybe people will take less transportation, maybe buy less car, or maybe less traveling. So like plus liners, Perak Transit, and then go down because not many people are gonna go and travel so much next year. So don't touch on these two sectors. Telco and transport. Alright. So as a summary, if you notice, long term you see this technology, medium term technology is there, short term technology is there. I put an asterisk there is because it indicates signs of weakness because they just want to retrace. But nonetheless, on the longer term horizon, it is still in bullish state. So technology is still the game for next year. Nonetheless, consumer, which is a bit more defensive side of the investment, it is also in the bullish state. So something that if you want to buy something for dividends, yes, you will get dividends. At the same time, you get the price appreciations. And in terms of short term, plantation remains, medium term plantation is there, long term plantation is there. So the catalysts for the plantation companies are still there. So sectors to focus, plantation. Why? You look at the CPO price has shot up quite high, 2,800. And a lot of these companies, their cost is actually around 1,005. So imagine how much cost of running the operations. Big companies like KLK is 1,004. Smaller companies is like 1,008. So anything sub 2,000 or the price of CPO above 2,000, they're making tons of money. So imagine it's 2008 now. So they're making a lot of money. So plantation is one of the sectors that I like to focus for next year. Alright. Nonetheless, other companies, other sectors like construction is just there, so it's not that strong. So I will focus on technology and plantation. And if you're looking for dividends, consumer is still there. Because consumer, longer term and medium term, it is still on bullish state. So you're getting both the dividends and also the price appreciations. So as a portfolio manager, yeah, I look at these kind of companies to look at and put the money in. So as you all know, I'm also in charge of the equity investments and also fixed income, and I'm managing about 2 billion worth of assets. So to be honest, even this year I surpassed my target because of these sectors, technologies. Okay? Alright, that's all from me. Any questions? Yeah.
What's your views on the energy sector?
Energy sector. At the moment, I didn't put the chart there because the chart also is not that great. Yeah, so I don't bother to put the chart. But the view is, energy sector, there's not much catalyst. The price is still going to be there. The price of oil also is going to be there. It's just between $54 to $60 for next year, unless there's major catalyst happening. If there's a breakout of supply chain issues in the Middle East, of course it will give a catalyst. But nonetheless, I stay away for now because Aramco is going to issue the IPO, so I'm not sure what's the immediate impact in the energy market. So I will stay away first unless things have been more calm. Then I will look at energy sectors because the Aramco oil IPO is one of the big catalysts, and a lot of other companies in the oil sectors actually have share inside the IPO. So I would stay away for now, but I will monitor that sector. Yep.
Furniture and rubber stocks. Consumer.
Yeah, furniture and rubber stocks. So that one also I didn't cover because I didn't see much catalyst on the furniture and rubber stocks. Because at the same time, in terms of the global outlook, the growth is a bit subdued. Of course, Bank Negara and also other central banks are stepping in. Fiscal policies are there to help ease the tensions in the economy. I don't really look at the moment rubber and furnitures, but nonetheless, if you look at the slides, rubber and furnitures is all under consumer actually. There's another subsectors, industrial products, but yeah, it's under consumer. Something that I will look at, but I don't see much catalyst in terms of price movement. Yeah. Ringgit exchange rate. Okay, good question actually. Let me just go through one slide. Yeah, bear with me. Okay, this is on inflation, right? Actually, there's another slide that I prepared. Actually, yesterday this is some of the slides that I used to present to my board. So there another slide that I don't want to present is basically on the exchange rate. So what happened is dollar ringgit roughly about 4.18 now, and anything higher than 4.18, even higher than 4.20, will cause further inflation in Malaysia. And because of that, I've seen the trend. Bank Negara tried to cap dollar ringgit at 4.20. At the same time, when they cap it, impact in terms of the international reserve figures. Okay, so the question is, how much longer Bank Negara can defend that 420 level? That's why my view now is there will be another cut. Why? Because now dollar ringgit at 4.18, and at the same time, pressure from the IMF, pressure from the government to get 4.8% growth for next year are there. So in terms of risk, and if I want to put a bet, this is a huge bet, I would say. And at the same time, there's another slide show that I didn't show today. A lot of foreign flows since 2015. If you remember 2015, what happened is actually the YMDB issue. So after that issue, a lot of foreign flows, especially the MGS, a lot of foreign holdings actually they liquidate their position and take away their money. So flows has been happening since 2015. Foreign flows. So now Malaysia is too cheap. You just need to have one catalyst, one certainty in terms of policy, then things will be okay. If nothing happens, say things still maintain like what it is today for next year, then it will be trouble, I would say. It will be tough for the policymakers and the government to make sure our economy is strong. Yeah, only one thing, one catalyst, certainties in the political scene. All right, any other question? Nope. So I guess that's okay. One more question. Yes. Yeah. Small cap, right? Yeah. Yeah, correct. So, I think let me repeat the question. Your question is more like this small cap valuation is cheap now is because of it's an aggregate of all companies in the small cap where you have the profit making, you have the loss making. So because of that, when you take the aggregate, the mean, it distorts the figures. But my point of view actually comes from asset valuations in terms of sector. So normally, as investors, say I'm from Hong Kong. I mean, from not Hong Kong. Hong Kong is a bad example. I'm from US. I want to invest in Asia, and I'll look at what kind of country I want to invest in. So I look at the whole valuations. Hey, Malaysia is cheap. So if Malaysia is cheap, okay, what are the subsectors we have? We have the FVM-KCI, which is the main, the mid cap, and the small cap. So for the mid cap and small cap, there's a bit of valuation, but the mid cap is a bit expensive. So for me as an asset manager, I will look at the FVM-KCI and also the small cap. So this is how they form their macro view. So from there, when you look at the small cap, hey, the small cap, of course, is an aggregate of all companies in the small cap companies. Some are making money and some are losing money. I'll focus who are the companies in the small cap that is making money for me to buy, or not just making money, but in the turnover state. Maybe they are losing money. At least the pace of money that they lose is actually improving after a few years. So yeah, to address your question, actually it's just the macro, how you form the view. Imagine yourself like in tunnel. So you have a filter like a triangle. So you filter one by one. So after looking at the small caps, then after that, then we look at what kind of companies we want to focus to invest in. So nonetheless, the point is for next year, yes, you still have room to look at FVM-KCI companies. At the same time, look at the small caps. The mid cap at the moment is just on the high side in terms of valuation. Of course, there are companies in mid cap that are making money that we can invest in today, but still in terms of macro view, yes, you look at those who give you better probabilities and better valuations. Okay? Alright, any other questions? Did I answer the questions? No? Or maybe we can take it offhand later on. Okay, any other question? Yeah. Bitcoin. I don't cover Bitcoin actually. But I know a lot of central banks now embracing, not Bitcoin, cryptocurrencies. So a lot of central banks now started to embrace cryptocurrencies. Malaysia also, Securities Commission has approved our first cryptocurrency exchange called Luno. So the direction is there. A lot of people are embracing cryptocurrencies. But in terms of the view, I don't have a view on cryptocurrencies. Because I know the original intention of using cryptocurrencies is actually to make things more simpler. For example, if you're on the supply chain sectors, you use cryptocurrencies to match your invoices easily. So it's all part of the technological advancement in the, I would say, IR 4.0. So yeah. Yep.
How will the implementation of cashless society impact on the market?
Cashless society, okay, the question is, how does cashless society impacting the market? Quick answer is actually it's positive. Why? Because in terms of financial literacy are getting better. And the transformation, the transfer of fund flows are getting faster. So when Bank Negara mooting about cashless society, it's quite good. It's a good initiative. And why China is one of the fastest growing economy, although now people say IMF outlook is going to be bad for the whole world, still on Asia's side, for China, people are looking above 6.0% growth. One of the catalysts actually in terms of their financial literacy. Financial literacy is not just about how you manage your money. No, it's not about that. But it's also about how the whole financial system works. So when things are more efficient and more optimal, then in terms of the stock market, so it's good for the business, it's good for the economy, it's good. So that's why in China now, if you can go there, you just use WeChat and just pay for everything. So that's how a good cashless society is. And Malaysia is moving into the right direction. Any other question? So if not, I'll pass. Yeah, one more question over there. Yes.
Here's the thing I'm trying to understand. We have funds flowing out, okay, overseas funds going out. Then, so then you say that what I call our market is cheap. Okay. So does it mean that the foreign fund managers, they are repositioning their funds at this point of time, whereby they are moving their funds out first, then waiting for our market to drop further, then to come back in?
There are two sides of the coin. The question is, the foreign fund managers are moving out from the market, whether they put it in cash or they pull out their money and put it back in their country, or they put somewhere else in Malaysia. So now there are two sides of the coin. There are a few fund managers that prefer to, because the ringgit remains stable at the moment, 4.18. So most of them, when they exit from the equity market of Malaysia, they park their cash in cash. Why in cash? Because I don't see any movement in our MGS. If they park their money from equity to bonds, the bond price for Malaysia should go higher and higher. But that didn't happen at all for the past 2 months, 3 months. Our bond MGS yield still remain at 3.41%. And yesterday, roughly about 3.42%, roughly around there. Doesn't move at all. But equity foreign fund holdings are getting lower and lower. Hence, at the same time, you look at the dollar ringgit, remains stable. And the latest figure by Bank Negara also remains stable. That means, what I can conclude from there, the funds now are parked in cash deposits. And it jive, if you notice, if you have corporates and you want to place money in your banks, the banks has dropped the interest rate for your fixed deposits from roughly for 1 month at 3.3, now roughly about 3.2. And after the SR cut, it's slightly lower. But so from there, you know there are a lot of cash sitting in the market, not just by foreign fund holdings, but also from our institutional investors. Because now at the end of the year, there's asset repositioning. And right now, there are a lot of uncertainties. There's conference in UMNO and PKR happening this weekend. So there are uncertainties over there. So people prefer to hold the cash. If something good come up, for example, in PKR, between Azmin camp and Anwar camp, yeah, people will start to have more confidence in Malaysian economy, and they start to invest in equity again. Yep. But to answer the question whether they want to pull out the money or not, if the ringgit goes to 4.20 and above, there's a probability. Why? If a foreigner invests in Malaysia, yes, you can get 3% in the bonds, but FX valuation will kill your P&L. Hence, they have to cut loss and get out from the country.
So that means that they are anticipating that particular possibility, right?
Yes, there's possibility, but they're not doing anything yet. They just wait and see, and they just park the cash here in Malaysia. Yeah.
All right, thanks.
Okay. All right. I think that's all.